For the millionth time, stop saving for them goddamn kids. Statistics have already shown that the vast majority of you haven't listened to that PSC. But even worse than that, most of you are saving inappropriately or ineffectively for your kids. I'm going to give you 4 alternatives to saving cash for your kids. And the gift of this is all 4 can be set up with your bank. So, statistics that I'm going to pull up in a minute show that the vast majority of us are saving for our children. Kudos to that. But the problem is the vast majority of us are saving in cash for our children. That's the least effective way to save for your child's future. I want to give you 4 more valuable resources that you'll be able to set up at your bank relatively easily over time that will be much more valuable for your kids when they get to their adult years. Now, the first thing we need to do is put context on what we're looking to accomplish. Most of us are looking to give our children a better future than what we had and a better platform than what we had. We're looking to close the wealth gap by creating generational wealth, and that includes making sure that our kids have a great start and have the resources they need to build wealth in their lifetime and hopefully to pass on to their children. So I get it. I'm not discouraging you saving for your child. I implore you to save for your child. But there's a few things that you need to understand about how the financial system works that's going to make saving for your child more effective. So for those of you who don't know, I'm JP, the founding architect of the channel. I'm a career banker by trade, been in financial services and banking for over 14 years. I manage a client book of $25 million plus in consumer and small business relationships. I have a mortgage license, FINRA investment license, life insurance license, and small business banking certified. So I help clients like yourself on a daily basis with exactly what I'm going to cover in this video. That aside, we need to talk about why saving in cash is such a bad idea. Let's take a look at these statistics real quick because they're pretty powerful. So, as you can see, somewhere around 75% of parents are saving for their kids' college. And this is including general savings as well. It could be college, it could be whatever. That having been said, you'll see in here that there's statistics showing that somewhere in the neighborhood of 83% of us are saving in cash. And it may not be right here on the front of the page, but somewhere in the statistics, somewhere around 83% of the 74 or 75% of us that are saving for our kids are saving in cash. Absolutely terrible foundation. Now, mind you, I get it. It's better than zero, but it is literally the least effective way to save for your kids. On top of that, if you look to the bottom where it says sacrifices, you see over 60% of us are saving for our kids at the expense of our own retirement and emergency funds. That's what I have a problem with as a banker, but we'll get to that towards the end of the video. So you see here, there's a serious consciousness around saving for kids, but there's a serious ineffectiveness around saving, and that's what we're looking to cure in this video. So just to get back to home base for a second, what are the 4 alternatives that I'm recommending that you set up at your bank that is going to be more advantageous than cash? The number one thing is going to be credit. And I'm going to explain to you how you can stage for your child to develop healthy credit earlier on. The next thing is going to be assets. I'm going to explain to you why that's more important than having cash for them. The next is going to be relationships. Probably shouldn't have to tell you, but relationship capital is extremely invaluable. And it is something that you need to be passing to your kids as well. The last thing is going to be knowledge, not least, but the last is going to be knowledge. Making sure that your child has the foundation to financial literacy. So whatever they encounter or get their hands on as far as assets or inheritance, they know what to do with it. Statistics already show that people hit the Powerball and the lottery all the time, and the vast majority squander the money. Statistics also show athletes and entertainers, nearly 60 to 7% of them are broke after they retire in their careers or if they fall off. It doesn't matter how much money you have. It doesn't. It doesn't matter if you have $100 million in the bank. It doesn't. You hear athlete and entertainer after entertainer talking about how $10 million isn't any money. $50 million isn't any money. Not too long ago, Odell Beckham, $100 million isn't any money. When you don't have financial literacy, of course it's not any money because there's always something to spend it on. So those 4 things, credit, assets, relationships, and knowledge are going to be way more valuable. And I'm going to walk you through how you can set these at least the foundation for these things up right at your financial institution. So if we start with credit, the first thing we need to focus on with credit is understanding that we are in a credit-based system. The vast majority of us have been watching video after video or Instagram post after Instagram post or TikTok after TikTok talking about our credit scores going away. Are they scrapping credit scores? Is the barrier of credit scores finally ending? It's never going away. It's not going to end. We're in a credit-based system. And as long as we're in a credit-based system, we're going to continue to have metrics for credit worthiness. We're in a debt-based society. That's not going anywhere. The vast majority, literally over 85, 90+% of the world's money is credit, not saved cash. It's credit, money created out of thin air. And as long as that's in place, which for the foreseeable future it will be in our lifetime, you're going to have a credit worthiness metric every single time, because that's what keeps the system going. Borrowing and money being paid back. Borrowing and money being paid back. If you don't have a metric in place to assess credit worthiness, the entire system collapses, because at that point in time when money's borrowed and not effectively paid back at scale, the house of cards comes down and the economic system globally collapses. So I'm putting a broad case spectrum around credit scores not going anywhere. Some variation of credit worthiness metrics, rather, it's not going anywhere. Now, the next foundation to credit worthiness is cash flow management. And this is where you can start to go to your bank and lay the foundation for your child's future when it comes to credit. Because when you go in to your financial institution and establish a healthy banking relationship, then your cash flow management, and you attach your child to that. So that means you just adding your kid on to your account. Now, mind you, not your primary account, because they probably won't be of age to be on that account. But we're talking about you setting up a relationship at that bank and then adding the kid's youth account, checking account, or the savings account, the uniform transfer to my. You going in and setting up the same accounts that y'all probably over saving cash in right now. So you're probably already familiar with this step. Puts them in the financial system and attaches them to a healthy client in the eyes of the bank. I'm going to be covering this a lot more, and I've already covered it in several dozens of videos on this channel. Relationship banking is the foundation to credit development. Cash flow management is where banking relationships come into play, and that's the founding pillar to credit development. If you're managing your cash flow, so you establishing a healthy banking relationship opens up borrowing opportunities for you, because the bank has the data in-house to tell if you're managing your money well and you have a likelihood of decent credit worthiness. When you attach your child to that, it becomes a household relationship. So you can attach a spouse, you can attach a family member. They're going to be viewed in a high light based on your work, your efforts, and your management. So the first thing you can do is just set up a healthy banking relationship that you're not overdrawing your account, you're keeping healthy cash flow in, you're saving in, and maybe even investing, and you're attaching your child to that by simply opening up an account that's appropriate for them at their age, and then also maybe making them beneficiaries on the accounts that you have. That's the first thing that's going to lay the foundation. The next thing is when you start to have credit cards, most financial institutions, or a decent percentage of them, you can add other people onto those credit cards as authorized users. Yes, that still works in today's world so far. Not every institution will report it to the credit bureaus. Most will, a decent amount will, but not all of them do. But at minimum, that financial institution is counting that credit worthiness to that authorized user, aka your child. So setting up great deposit relationships and then adding them on to great, well-managed credit cards is laying the foundation. By the time they're 18 and they're able to fully bank on their own, or whatever the age of majority in your state may be, now they can set up their deposit relationship as a branch out from the household relationship that has great credibility. Then the credit card reporting portion, if it's being pushed out by that bank, can now jump on actively to that 18-year-old's credit report, because they're of age now to generate credit. So that's how you set the credit portion up. It's not that hard, but it is very profound by the time that child gets of age where all of this data can start to report in their name. So the next thing is going to be assets. Why do we want to set up assets, and what does it look like to set up assets for that child? You want to set up assets over cash because assets will have a positive real rate of return. Assets are going to actually keep up with and potentially outpace inflation. And these assets can be set up right at your bank. Two prime examples that are time tested: real estate and stocks. You can literally purchase real estate through your bank, and you can set up a stock portfolio at your bank. You can't add your child onto those directly, but you can make them beneficiaries until they get of age. So what does that look like? You buying property through your bank, which again builds your credibility with your financial institution, and then legally structuring things where you either buy it in your name and maybe the child's a beneficiary in a will on the back end, or if you're really savvy, maybe you're buying it in a business name and your child's a part of that business. And if you really want to go all the way next level, maybe you buy that property and you're able to do the due diligence and connect with the right professionals to put it in a trust. And that child is attached to that trust or a part of that trust. There's ways to go about this, and almost everything I just said can be done at most major financial institutions in-house. This is going to be the next part when we start talking about relationship development. But you can buy these assets, and then the same thing in a stock portfolio. Set up an IRA or a brokerage account within the financial institution you're doing your banking at. A lot of these financial institutions have the deposit in, the consumer deposit in, and they have the brokerage or wealth management division of the bank. All of that's pretty much in-house for them. You go to them and get that set up, build that stock portfolio, add the child as a beneficiary, or again, you set up a legal structure that stock account is sitting in and that child is a part of. At minimum, once they're 18, you can work on adding them on or transferring to them. But this is going to be way more valuable because stocks and real estate both are certain to keep up with or outpace inflation, because inflation is the rise in cost of goods and services. What is real estate? It's a good. What is the stock market made up of? Companies that provide services. So when these things rise directly, the companies that are providing the services are becoming more valuable. The real estate is becoming more valuable. It's one of those goods that's inflating in cost, or it's taking more dollars to purchase. So you want to go through your banking relationship, build up your credit worthiness, build up your cash reserves so you can invest, set up your stock portfolios, buy real estate, and structure these things properly so your kids can be heirs or part owners in these assets. Because this is going to keep up with or outpace inflation versus you saving $10,000 in cash for 10 years. And then by the time it gets to that child in 10 years, it only buys them $6,500 in goods and services because inflation ate away at 35% of it. Does that make sense? Comment down below. Now, the next portion, this is going to be relationship development. You developing relationships with that bank, as I used an example of setting up your healthy deposit relationships. The bank's paying attention and collecting data on that. You're literally being scored. It's not just Navy Federal's internal score. Every bank's internally scoring you and assessing the level of the relationship based on how you're banking with them and borrowing from them and investing with them. So the relationship with the bank itself is number one. But within that, there's the bankers. There's financial advisors and wealth managers. There's home lending advisors and mortgage loan officers. There's small business relationship managers and small business bankers and relationship managers. All of the different mechanisms to wealth creation, there's a professional there that specializes in it at your bank waiting for you to reach out to them or to answer the call that they're probably reaching out to you. When you set up good relationships with these professionals, they're going to know lawyers, attorneys, they're going to know accountants, they're going to know other professionals, even if it's outside of the bank that they can plug you in with. Now you're developing a relationship that your child can inherit their own financial team. And that's going to be more valuable than any cash savings you can ever provide, because now that child is insulated by professionals that you have a good brand with, that are invested in your financial future, because every single one of those professionals get paid the richer you get. The small business specialist makes more money when you need to borrow $100,000 versus needing to borrow $25,000. The home lending advisor has a vested interest in seeing you do better, because when you buy a $500,000 home, they make more money than when you can only afford a $150,000 home. The wealth manager makes way more money if you invest $500,000 than if you can only invest $50,000. The more complex the legal structures you need set up to protect your assets, the more money the attorney can make. The same thing for the account. The more money on your balance sheet, the better your balance sheet, your net worth, the higher it is, the more money that certified public accountant can make and can charge you respectfully. They have a vested interest in seeing your assets grow because they make more money. So does the bank. So you setting up these relationships and passing that along to your child. And again, the vast majority of community, regional, super regional, and national banks all have some variation of these professionals. It's just your job to nurture and develop those relationships. Way more effective than cash. The last one is going to be knowledge, financial literacy, the information you need to turn words into wealth, as I see. This is right at your bank. I'm going to share my screen one more time for you guys to be able to see exactly what I'm referring to. So give me a second. I'm going to share with you an example. I'm just going to use PNC Bank as an example. So they're a super regional financial institution, and they offer deposit accounts, they offer investment accounts, they offer lending products, small business products, wealth management, corporate and institutional funding options. So they go all the way up the ladder. All right, here we go. So as you can see, this is going to be the personal banking relationship side. You go under here to learning, explore topics. They have financial education topics for saving, spending, borrowing, investing, wealth management, small business, and the list goes on. What is an example of what this looks like? Just a quick skim through. Interested in benefits of building savings, saving strategies, savings tools, financial literacy, types of savings accounts. What is a custodial account? UPMA accounts that I just described, benefits of savings accounts, CDs versus savings accounts, where to put your extra money. This is financial literacy right here at your financial institution for free by credible sources, by the way, versus you watching random people on TikTok who have no background in the financial field, by the way, most of the time. Let's go back again. What does it look like when we start talking about borrowing, for instance? Long list of topics that they cover. Auto lending, financial education, credit score, financial education, debt consolidation, debt management, education around broader lending, home improvement, home refinancing, mortgages, personal lending. There's financial education across the board, as you can see. So what I wanted to do was give context, and this is just a quick skim through. I'm not going to spend a lot of time here. Every single financial institution has some level of financial literacy. Part of it is mandated by law. I don't know if you guys ever heard of the CRA, Community Reinvestment Act. I'm going to be covering a lot of content around that in the near future because a lot of you don't understand. It's designed to help you close the wealth gap through your bank. That's literally legislation there. Part of that is dictating every single one of these financial institutions that's insured by the FDIC have financial literacy programs in place. Your bank is required on some level to have something in place that provides education for you as a client and your child and your household. So the fourth pillar being knowledge and financial literacy is going to empower your child to go out and whatever money they encounter that they earn, inherit, whatever the case may be, find on the street, they have the knowledge to do something productive with it. Because you can work your ass off to save for these children and they don't have the knowledge, it's going to be gone. I promise you. And most of you can relate to this. I know you can. Comment down below and tell me your scenario or experience where you've already seen youth in your family squander money, or your peers, your siblings. Your parents tried to save for you and your siblings, and you or one of your siblings squandered their money because they didn't know any better. So to wrap this video up, I'm going to tell you why I do not encourage saving for your children in the first place. I already covered this in one of my more popular videos like a year and a half ago on the channel. It didn't get like 1 million views or anything crazy like that, but it did really well relative to my channel, and it got a ton of engagement because so many people could relate to that video when I shot it. I might try to link it in the description. But ultimately, to surmise why I do not, as a banker, literally as a financial professional, do not encourage you to save for your kids, or at least not to save for them as the primary. Let's go back to the foundation of what I was talking about down in the statistics section, right? Where they talk about how 60+%, statistics show 60+% of us are saving over our own savings for our children. We're literally saving more money, attempting to save more money for our children than we're saving for ourselves. Let me see if I can get this up here real quick. Here it is. You see this section down here that says sacrifices? Statistics are showing somewhere in the neighborhood of 60% of us are saving more for our own children than our retirement and emergency funds ourselves. Unacceptable. Every time you get on a damn airplane, they tell you put your own mask on first. You are going to be much more valuable to your child's financial future as a whole, but financial future, than any amount of cash you can save. If you're debt burdened, if you can't retire, if you don't have savings in place to help protect you when your health starts to decline and you start to get expensive medically, you'll be a much broader burden to your children than any amount of cash you can ever save for them. You're a much greater asset to your kids, never saving a penny for them, but being financially stable yourself, providing them a life that comes with that financial stability, and just giving them the basis to go out and do well for themselves. I'd rather you have a great retirement, your emergency funds in place, owning a good amount of real estate, doing well at your job, financially stable, or owning and running a successful business, giving your kids the gift of coming up in a home, an actual own home. Tons of statistics showing socioeconomic differences in kids who come up in renting environments versus those who come up in a home that's owned, and the community difference, and the psychological difference, and the way they value assets, communities, and education. You having a credit score of 700 plus, John Hope Bryan covers this beautifully. You having a credit score of 700 plus shows amplified significant financial benefits and upbringing benefits for your child versus coming up in a community of 580 scores or 600 scores. You having a better credit score, owning real estate, owning stocks, having a successful career, or running a successful business, and saving not a penny for your child is going to be magnitudes better than coming up with a poor credit score, job instability, no savings or investments of your own, but having $5,000 to $10,000 or $15,000 saved for your child. The impacts of you not being financially well off and situated is magnitudes beyond any amount of cash that you'll ever be able to save. Hear me when I say that. The magnitude of you being financially stable and the opportunities that will come from that and the environmental impacts that will come from that for your child is well beyond any amount of cash you could ever save for them. So I always promote, don't save a penny for them if it's not feasible for you, meaning that you can't save for your own retirement and own emergency fund and buy and own real estate and maybe invest in and start a business of some sort. If you can't afford to do those things on your own, don't save a penny for your child. I'd rather you buy life insurance in case something happens to you before that child becomes of a reasonable, responsible age. Buy quality life insurance. Other than that, the only thing you need, if you're alive and well, the only thing you need to be focused on is building your own financial future and stringing your children and your household along with you. That's way more valuable. And put life insurance in place in case you get clipped down before you can accomplish that goal of financial stability for yourself and financial abundance for yourself. That's what I always recommend, generally speaking. That's way more valuable than you barely having a retirement but pouring money into a 529 plan for your child. For what? For what? What do you think you're doing? Save yourself. Here's a life raft. Here you go. Like, here, save yourself. I'm drowning in the background. Like, what do you think you're accomplishing? That child is going to have the burden, likely if they give a damn about you, of you falling apart and likely you reaching back out for them later in their adult years. Save yourself. Here's $10,000 in your college fund, but I can't retire and my medical bills are outpacing my income. Great. Wonderful. Thanks so much, Dad. Thanks, Mom. You guys are the best. So comment down below and let me know what it is that you have in place for your child. If you're a parent or a guardian, what are you doing to save for your kids? What have you learned from this video? What are you going to tweak or do differently if you're already saving for your kids and you're part of the problem accidentally by saving cash instead of any of these other 4 fundamental pillars that I set up for you in this video? Credit development, assets, relationships, financial literacy. Let me know what you would do differently, or let me know if you're a younger person and you're just getting into your adult years and you're a victim of your parents attempting to save cash for you but not being in financial position for themselves and it burdening you. Just comment down below wherever you are on the spectrum and keep the conversation going, because this is a really, really powerful topic. I want you to comment down below, like, comment, share, subscribe, support the channel so the channel can continue to support you. Get in the description section down below. I've branched out on Instagram and branched out on TikTok by the time of this recording. So you can get in the description section down below to get more financial content for information and inspiration. Other than that, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.